Capital budgeting and inflation. Inflation isn't something we've spoken about in terms of capital budgeting here up to this point. And it's something that's kind of been there, but we haven't been aware that it's been there. And so what we're going to talk about here is just kind of making certain that we deal with inflation properly. And also you need to be able to make some calculations to take inflation in or out of the numbers that we're dealing with. But the issue that we have is because capital budgeting is looking at projects that go many, many years into the future, the cash flows that we see will see the impact of inflation. And we know just from life, inflation is prices going up. And so even if we sell the same number of units for the next 10 years, because prices are going to go up, our revenue is going to go up. And so just because our revenues are increasing in the future doesn't mean we're selling more units. Maybe we are. But maybe part of that expected increase in our sales revenue is a function of inflation rather than a function of increased sales quantity. Okay. So when we're talking about inflation with capital budgeting, this is really the main thing that we need to remember. To properly include inflation into the process for capital budgeting, both our cash flows and our rates of return need to be measured in the same way. In other words, if we adjust our cash flows for inflation, then the rate of return also needs to be adjusted for inflation. If we don't adjust the cash flows for inflation, then we can't adjust the rate of return for inflation. And so the two categories of terms that we need to be familiar with here are nominal and real. The nominal cash flow, the nominal rate of return, and the real cash flows and the real rate of return. And then you also need to be able to do the math to go back and forth to convert a nominal to a real or a real to a nominal. And so what we need to do is start by talking about nominal cash flows, nominal rates of return, and then the real cash flows and the real rates of return. So we start with nominal cash flows. Nominal cash flows include an adjustment for inflation, and this is what we've been using. We haven't talked about it, we haven't said explicitly, but nominal rates and cash flows are what are normally used in capital budgeting. And it is simply the number of dollars received. Okay, the nominal cash flows, how many dollars are we going to get next year, 2 years from now, 3 years from now, 4 years from now as a result of this project? How many dollars are we going to have to pay 2 years, 3 years, 4 years, whatever the case may be? So if there's a period of inflation, our sales revenue will go up even if we don't sell any more units because the price has gone up. And so our revenues are going up, but we really haven't earned that in the sense that our quantity has stayed the same. Okay? Sales price goes up, so our revenues go up even if quantity remains the same. Now, when we incorporate the inflation rate in this, that's our revenue going up each year. Okay? Even if the sales stay the same. So nominal cash flows include an adjustment for inflation, which means we're assuming prices are going to go up for what we sell and what we buy. Now, the nominal required rate of return consists of three parts. Three elements make it up. There's the risk-free rate of return. Okay, this is assuming no expected inflation, that long-term government bond rate. Then there's also a risk premium for the business risk that we have. And then also in a nominal rate of return, there's the element of inflation. Okay, it's above the real rate. Okay, this is what we expect is going to happen, that expected decline in purchasing power due to inflation. Now, rates of return quoted on financial markets are nominal rates. Because if you're an investor, you are going to need to be compensated for the risk-free rate, the risk premium, as well as inflation. Okay, so this is what we're normally working with. Now, that was nominal cash flows and rates. Real cash flows represent the cash flow and the rate of return if there is no inflation. What would the cash flows be with no inflation? So this is purchasing power. When we take out inflation, our revenue number is going to go down. Because if our quantity stays the same and we take out inflation, price stays the same and revenue stays the same. If we find that our real revenue has increased, then we've done something to earn it. Either we're selling more, or we've been able to raise the price not connected to inflation. Okay, there's price goes up because of inflation and price goes up because of demand. So if our real revenues go up, something good has happened for us. We've either sold more or we've been able to raise the price not connected to raising the price due to inflation. Now, the real required rate of return has two elements to it. Okay? Those two elements are the risk-free rate of return and the risk premium. We're not taking into account inflation here. Okay? It's the rate that's required to cover the risk of the investment. Doesn't address inflation, just that risk premium, that risk that we have connected to whatever this investment is. Now, the next step in all of this is to be able to convert one to the other, and so we're going to go through the math process for it. This is something that is mathematically not difficult. It's something that in a perfect world, I would be able to tell you you don't have to worry about it, but it's not a perfect world. You do need to be familiar with this so that you're able to make these conversions if you get a question about it. So we start with converting nominal dollar amounts to real dollar amounts. Okay? So if the nominal expected cash flow needs to be converted to a real expected cash flow, the nominal cash flow divided by 1 plus the inflation rate raised to n number of periods. How many years from year 0? Okay? The nominal cash flow divided by 1 plus the inflation rate raised to the number of periods. So, for example, $11,000 nominal expected cash flow to be received in 1 year when the inflation rate is expected to be 2% annually is the equivalent of the real cash flow received in 1 year of this amount. We take that $11,000, we divide it by 1 plus the inflation rate, and it's raised to the power of 1 because it's only 1 year. So that $11,000 nominal amount to be received in a year is really only $10,784. Okay? Because there's a 2% inflation. Now, if we take that same $11,000 to be received in 2 years instead of 1, we have the same formula, except now the 1.02 is raised to the second power because it's 2 years. And so it goes down a little bit more. So the real amount of money, the real expected cash flow of $11,000 in 2 years is $10,573. Okay? So another way of looking at it is if we had $10,573 of sales right now, 2 years from now that'd be $11,000. Okay? That approximation in terms of that. Now the next thing is to convert the nominal to a real rate. Okay? Not cash flows, but an interest rate. To do that, the math is simple. 1 plus the nominal rate divided by 1 plus the inflation rate minus 1. Okay? So we've got a simple formula here just to convert the rates. So with a nominal rate of return of 6% and an inflation rate of 2%, we convert it 1 plus 0.06 divided by 1 plus 0.02 minus 1 is 3.92%. Okay? The nominal is 6%, but when we take out the 2% of that, that just was because of inflation, not because of anything we did. When we take that 2% out for inflation, the real rate of return is 3.92%. Okay? The real rate is going to be lower than the nominal rate. Now we need to go the other way as well, converting a real amount to a nominal amount. So the real amount, the real expected cash flows need to be converted to nominal for our capital budgeting purposes. And here's how we're going to do that conversion. The nominal cash flow is equal to the real expected cash flow multiplied by 1 plus the inflation rate raised to the nth power, again, n, the number of years that we're talking about. Okay, to convert that real into a nominal, for us to put it into our capital budgeting, here's our formula. Now, we've got a bigger example here. The following illustrates the real expected cash flows converted to nominal expected cash flows. We assume that the real expected cash flows inflows are $10,000 per year, and the annual inflation rate is 3%. So those real cash flows, 10,000, 10,000, 10,000, that's based on, no inflation. Okay, no inflation. So when we're putting inflation into that, we take the $10,000, multiply it by 1.03, then 1.03 to the second power, and so on. $10,300 in year 1, all the way up to $11,255 in year 4. And so for capital budgeting analysis, we use the nominal expected cash flows calculated. That's the amount that's going to go into all of our calculations. We don't have to adjust the initial investment because it's done at year 0. There's no inflation yet. Okay, so it's the nominal cash flows that are going to be adjusted for that. Now, the next one that we need to look at is calculating the nominal rate. The normal rate of return is 1 plus the real rate of return multiplied by 1 plus the inflation rate minus 1. And so go through an example with this. If inflation is expected to be 3% per year, to convert a real rate of return of 5% to a nominal rate of return, calculation. We've got our formula, 1 plus the real rate of return times 1 plus the inflation rate minus 1. We do that math, 1.05 times 1.03, 8.15%. Okay? So the real rate was 5%, inflation is 3%, the nominal rate is 8.15%. Now, I understand as I go through this quickly, the numbers kind of run together, but you need to just recognize that the real rate is going to be lower than the nominal rate because the nominal rate has inflation in it. It's the nominal numbers that ultimately we're going to be putting into our capital budgeting project usually, the way that's normally done. But you need to be able to take this conversion back and forth. I could see a multiple choice question about something like this. We have an example in the book that goes through over a number of years this larger calculation. You're not going to have to do that on the exam. That's not going to be a question or a problem. But we just have it in the book if you want to kind of work through this over longer periods of time. But what we're looking at here is inflation and what we need to do with it. And the takeaway, if you ignore all the numbers, the one takeaway is this. When we're doing capital budgeting, we have two things. We have the cash flow and the rate of return. They need to be done the same way. If we use nominal cash flows, we need to use nominal rates of return. If we use real cash flows, we need to use real rates of return. We can't mix and match. Okay, so if we're using adjusted for inflation cash flows, the rate of return needs to be adjusted as well. We need to be comparing like with like in that sense. So your takeaways are cash flows and rates of return need to be the same. Nominal or real, they need to be the same. And also then these calculations, how to make the adjustment back and forth. Just keep in mind that the nominal cash flow is more than the real cash flow. The nominal rate of return is more than the real rate of return. Okay, that can kind of help you if you have to guess somewhere along the line. Just make certain you guess that the nominal is higher than the real. But taking into account inflation, again, we didn't talk about it. It was just kind of there in the background. But these are the adjustments. And again, the cash flows and the rates of return need to be the same. They're either both nominal or they're both real. Most likely it is nominal because it's the nominal cash flows, the nominal rate of return is what we traditionally use in capital budgeting.